This week, I'll cover Nvidia earnings, just one company, so we can have a focused discussion on the earnings. So I'll go through a couple of slides and then I will go through one element which is from the Q&A of the earnings transcript, which I think is worth to share because I think that's quite important. Okay, let's go through the financial number first. So the first one is total revenue. This is on last 12 months basis. It grew by 114%. I think for those who have seen, I show this chart, you know that revenues is going up trajectory. The question is like, will this growth continue to go up or will it plateau at some point, right? I think that's the questions that many investors are asking. Then next one is showing the total revenue just on the most recent quarter. So the most recent quarter, they have 39 billions of revenues. So this is up 78% year over year. If you track this year over year percentage, right, you will notice that it's going down over time. And please don't be worried of that because it go down because the base is getting larger and larger. So say for example, let's say if 3 or 4 quarters ago, you are comparing against a quarter 1 year back when they are having, let's say 5 or 7 billions of revenue, right? Of course, they can generate a much higher percentage. But now the base is getting higher every quarter. So this percentage will come down naturally. So don't be concerned of that. Then if we look into the revenues, we can see that out of like their segments, so they have data center segment, they have gaming, and they have others, right? Actually, at this moment, we don't have to concern so much about other segments. For example, like gaming, their professional visualization, those other segments. I don't think that's important. In the grand scheme of things, right now, in terms of their revenue, about 90% of those revenue actually came from the data center. These are the GPUs that sits inside all these big data center, and one data center can have 100,000s of GPUs, right, of all these servers. So I think this is the main revenue driver at this moment. So it is quite a big numbers. I think last time when I invested in the companies, I think the gaming was still larger than the data center business. Now data center business is just like like 90%. So when we talk about growth, right, actually you just need to pay attention to the data center. For gaming one, I would say the things to look forward to is because they just launched their new 5000 series chips, right? So I think their gaming numbers will also go up, but that's just a small percentage of their total revenue and not so important. And these slides, I think every quarter when they release their numbers, you can see that there's this quarterly revenue trend. You can take a look at them. And then here you can see very, very clearly the data center revenues, are they going up or are they plateauing? You can see it from this table here. What we can tell from this table is that up until this recent quarter, right, their data center business is still growing very nicely. And even for the next quarter guidance, is still going up. I think many analysts, they have been talking about will this plateauing, will the growth slow down? I think I'm not saying it won't come because at some point it will come, right? The thing is that up until the recent quarter and the upcoming guidance, still no signs of slowing down. I think for this year, right, they're still going to grow. So I think that's very positive about the financial numbers. And then if you look at the details, right, for example, after they released the earnings, the share price tanked, right? The share price dropped. So I go and figure out, right, use some, like Grok or ChatGPT just to do some research to find out like why the share price dropped, right? One of the reasons that was given was that the gross margin was lower than expected. And then if you look at the numbers, right, gross margin is 73% for the most recent quarter. This number is still very healthy. Of course, you can see that there's a small dip there. And I think the dip is fine. It's not like a big drop there. I think the reason is also quite important because, for example, right, let's say if their sales already slow down, their largest customers stop buying or at least like reduce their purchase, right, reduce their orders, they have to attract more buyers. In that sense, they have to cut their prices. If they cut their prices, causing gross margin drop, right, I think that will be a lot more concerning. But right now, what we are seeing is that it is not the case. It is really just because the ramping of Blackwell, the expenses also higher for this phase. So the gross margin will be affected. I think for the upcoming quarter guidance also at similar level, the management guided that towards the end of the year, the gross margin will go up slightly. So in the around mid 70s. So this is not a big concern at this moment. There's no sign of pressure to lowering their products prices. So I think numbers wise for this year, they will still be fine. Next year is a question mark, right? So I also cannot say because let's say if next year they really have to cut the prices, they have to give discount, these kind of things, right? And then growth really slow down. Of course, the financial numbers can turn ugly. I'm not saying that will not come. It's just that at least for the most recent quarter and the upcoming guidance, they are all still okay. So that's gross margin. And EBIT margin, this is earning before interest and tax at 61%. Still very healthy number. Yes, we recognize that there's some small dip there, but nothing concerning here. Then you see, right, revenue going up, margin dipped slightly. Of course, the diluted net income continued to go up, right? On a last 12 month basis, they have generated 73 billions of net income. So 73 billions, very really healthy number, and the trajectory also keep going up, right? And if you compare 73 billion net income, right, these companies among the top companies in the world, right now Nvidia is already climbed up to the 6th place. I think this is, I am excluding those outside of US, just ranking the US one. They are at 6th place now. And if you just take the most recent quarter numbers, right, which is 22 billions, just multiply by 4, right, they are at 88 billions. So already quite close to 100 billions of net income just in a single year. This one just shows that how fast they are progressing, because there's so much demand on all these GPUs. Their numbers, financial numbers, really nothing to complain. It's really, really good. So you can see here, 88 billions is even above JP Morgan, right? It's already approaching Microsoft, Google's level. So that's the net income number. And then on free cash flow, I think the free cash flow numbers, at least for the most recent quarter, is slightly lower than the previous quarter, but it's still going up quite nicely. They have generated $15 billion of free cash flow. I think what I want to say here is that for some companies, although they have a lot of net income, but if you need to throw all this net income back to capex, right, then you don't really generate a lot of free cash flow, right? But for Nvidia, their free cash flow is really very healthy, 15 billion, and they can use this 15 billion to pay dividends, to do share buyback, basically returning the money to shareholders, right, which is always a good thing to do. So you can see that this is a table shown in their 10K filings. Just in the most recent quarter, they have purchased $11.5 billion of share buyback. So this is like just to show you that they really use most of this free cash flow, right, to buy back their own shares. So I think this is good, because imagine that, let's say now, right, the share price dips slightly. So if the companies continue to do share buyback, they are buying back at a much attractive price, right? So it's always good. I mean, I'm not concerned with all this small dip in share price, because the companies still, they are doing all this share buyback, right? I would rather they buy back a lot more of their shares. And this slide is showing that their shares outstanding. So right now, I think they have 24 billions of shares outstanding. I think this one, you can see that the trend is going down because they are doing all this share buyback, right? So it's always good. Then I think just a quick summary of their income statement, you can see that out of their total revenues, most of them come from data center. And then after you minus out the cost of revenue, minus out all the OPEX, right, there's quite healthy amount of money actually flow to net income. And out of those that flows to net income, quite a sizable actually flow back to shareholders' pocket via share buyback and dividends. So I think this company is still executing very well. The Blackwell, all the problems in the few last quarters, right, I think they have sorted out. Now Blackwell is ramping up, revenues going up, net income going up, and this year's orders all fully booked. If you just analyze the financial numbers and analyze the progress, right, I think really I can't find things to say that, oh, there's anything that's concerning, other than things that people speculate about. For example, like, oh, what's the growth for next year? Next year, I think still far away, right? At least we have 1 or 2 more quarters of good numbers, and then maybe next year we'll test again whether the market is big enough and then their customer continue to buy or not. I think that is something that some analysts or some investors, they are concerned about. But for me, I'm happy with my allocations and I'm happy with their track record. Okay, then now I think we want to talk about the valuation, right? Because since the share price dropped in recent week, right, some may ask, like, is this level, this price level, is it attractive enough? So usually I would do a discounted free cash flow approach to do valuations, but I don't do that often. Let's say after we have few quarters of financial numbers, I will refresh my numbers. But anyway, the one I think is just, it really depends on the assumption that you put in. So I'll rather keep it simple and then just look at one metrics, so that at least we have a consistent metrics to track, right? The metrics that I use for Nvidia is forward PE, meaning that we look at their market cap versus the forward next 12 months expected earnings and take a ratio of that, right? But before we go to forward PE, right, let's look at their numbers. Two lines that I'm showing here. The first one is their market cap. Okay, right now their market cap is about $3 trillion. It's a very high numbers, but you need to compare this market cap versus their net income, right? The net income that is shown here, this is based on last 12-month basis, is at 73 billion. So I think just looking at this slide here, you can see that there are 2 trends, right? The first one is that the market cap was quite low in the past. Say, for example, even as recent as 2023, you can see that their market cap is only around, let's say, $500 to $700 billion. But their net income back then also quite low, right? And then the net income just rocket up after all these GPUs, all this data center business ramping up, right? The net income going up, market cap also going up. So when we talk about valuations, we are not talking about the market cap. We are not talking about, the share price already went up by 3x or 5x. Actually, when we talk about valuation, you need to compare the valuations, compare the market cap or the share price versus their fundamentals, which I mean, here I'm using net income as an example. Some people may compare against sales. I don't think that's important. The important thing is that we want to look at the share price and market cap versus their financial numbers. Here is net income, both going up. And then if you take a ratio of these two numbers, right, then you get something like valuation metrics. Here, later we will look at the PE. Okay, so this PE here, the earnings slightly different compared to the previous one. The previous one was looking at the trailing 12 months. This earnings here is looking at next 12 months of the so-called the forward PE. So right now, the forward PE is at around 28. 28 for a normal companies, I would say that it is not cheap. But for Nvidia, because their growth is still high, I think often investors are willing to pay a much higher forward PE for these companies. Okay, just because their growth is still very high. Remember at the first slide here, I'm showing that even at year-over-year basis, they are still growing at 78%, right? 78%, some investors are willing to pay a forward PE of 40, 50, even 60, because if you just compare the PEG, right, it's still below 1. So that's why I think how much investors are willing to pay is a function of this percentage growth, which is the most recent growth rate, and also how long they think this growth rate can sustain. Because if you think that this 78% is only for the most current quarter, and then next year is going down, right? Of course, people are not willing to pay a lot higher, right? But for Nvidia, I would say that it's quite hard to estimate what is the growth rate for next year and the year after, because we don't know how big is the AI market right now, right? It's a new market. So I think that's the challenge. Some people willing to pay a lot higher, some people are just not willing to pay. So now come back to this forward PE chart, right? But at least we can look at this forward PE, compare it against the historical period. And by historical period, let's just looking at the recent 5 years, right? You can see that the forward PE usually traded between 25 to 60. Okay, so that's the range. Let's say if it is below 30, I would say that it's already quite attractive. And let's say if it is beyond 50, I would say that it's overvalued. Okay, so you can take that as a guidance, right? Just compare it against historical. Right now at 28 times forward PE, I would say it's already quite attractive. Am I saying that the share price will not drop? That's not what I'm saying. Of course, share price can be volatile. 20x forward PE can go down to 25, can go down to 22. Who knows? But it's just that looking at these metrics, just take one single metrics, right? At least it is quite attractive at current valuations. And then another thing is that we want to know that the revenues, the forward revenues, right? Because all these forward earnings it is also projected by analysts. And all these forward earnings, right? It depends on the expected future profit margin and also expected future growth. And by future growth, I mean how much revenue can go up, right? But at least based on the revenue estimates, right? This is revenue estimate for the next 12 months. Every quarter when they release earnings and then we move one quarter ahead, you can see that because of the company's guidance, or you can say that analysts, they have more clarity over another one quarter forward, right? So they keep on revising all these, their revenues estimates upward. At least now we are projecting that from, the upcoming 4 quarters, right? Their revenues will be about 200 billions of revenue. At least we are not seeing a slowdown at this moment. The analyst estimate is that it will still continue to go up. Last 12 months, you remember this number? The second slide, right? Or the first slide. The first slide, last 12 month basis is 130 billions. Next 12 months, they are at 200 billions of revenue. So at least the projected revenue is still going up, and then projected earnings is going up. And I think at least that's the future growth is kind of like, I wouldn't say guaranteed, at least people agree, and based on consensus, it will go up. I think that's why I say when it comes to all these financial numbers, whether it is looking backward or looking forward, things still looks good. But you have to remember all this can change one, because remember if we go back to year 2022, right? Suddenly the revenue slow down a little bit, and then analysts they will start to project the revenue to drop in the future quarters, right? That's why all this number is not one line up one. It can go up and it can come down. It's just that based on numbers that we have now, it is expected to go up. Okay, I think that's all about the financial numbers. As a reminder, let's say if you have any questions, it can be Nvidia questions, can be other questions, just let me know at the comment section. Let's go into the quarterly earnings call, okay? Because I think I just want to pull up one thing, because usually if there's 2 or 3 things that's worth to highlight, highlight. I'll go through that. But this round, right, I will just go to this one questions. But after these questions asked by Timothy, I think Jensen, he really answered quite a long answer. We will go through that in details. Basically, the questions from Timothy here is that, Jensen, we heard a lot about custom ASICs. Can you kind of speak to the balance between customer ASIC and merchant GPU? We hear about some of these heterogeneous superclusters to use both GPU and ASIC. Is that something customers are planning on building, or will these infrastructures remain fairly distinct? I think Jensen in the past, he also mentioned before, he said, who are their competitors? So their competitors is not just, for example, like AMD or Intel. Actually, they are competing with their customer. Say, for example, like Google, Amazon, and also Microsoft, right? All three of them, they are Nvidia big customers. At the same time, they're all designing their own chip. Specifically, they are designing their own custom ASIC. For those who don't know ASICs, right, this is a chip that is really, how to explain it? It is more tailored for a specific workload rather than generalized. The good thing is that in terms of their efficiencies, they can be quite high. It's just that they are not general purpose. So that's ASICs, right? So at the same time, they're buying from Nvidia. Also, they are designing their own chips. So it's kind of like competitions with their customers, right? I think the analyst here, he's trying to understand like what's the balance between ASICs versus GPU. At first, I thought that Jensen will say that, oh, for these kind of questions, right, he will say that, oh, there's always a place for ASICs, there's always a place for Nvidia GPUs. But that's not what he said. He basically trying to explain to the analyst that why Nvidia GPUs is superior and why they are winning. So we will look into more details about, break down what Jensen said when answering these questions. We'll go through one by one. Okay, the first one, general purpose versus ASICs narrow focus. Well, we build very different things than ASICs. In some ways, completely different in some areas we intersect. One, Nvidia's architecture is general, whether you are optimized for autoregressive models or diffusion-based models or vision-based models or multimodal models or text models. We are great in all of it. So I think what he's trying to say is that, you see, when customer buying Nvidia chips, right, they are buying Hoppers, they're buying Blackwell, but you don't hear them buying Blackwell that is specific for certain models. Okay, it's just Blackwell chips, right? Just general purpose chips. Of course, when they use for project A, they can shift to project B. I mean, it's just software, right? It's easily can be repurposed for other projects. Whereas, let's say if for customer they are using ASICs, right? ASICs is really good, but only for a niche area. If you want to repurpose, you need to have another different ASICs. Even the chip, I think what is it called? The Grok chip, right? Also, you need to fine tune the chips, or you need to change certain, you need to repurpose it, and you need to spend a lot of efforts to make it work. Of course, when it is working, when it is designed for certain algorithm or certain models, of course they can work very well. But the moment the model change, right, and you need to repurpose the chips, right, then it will be super headache for all these ASICs chips. So I think the general purpose here is very important, and it is a selling point for Nvidia. Okay, that's one. The second one, rich software ecosystem and flexibility. We are great at all of it because our software stack is our architecture is flexible. Our software stack ecosystem is so rich that we are the initial target of most exciting innovations and algorithms. Here he mentioned about the software ecosystem, because I think for those in the AI world, right, most of them are actually using Nvidia chips. They are using Nvidia software. At the same time, all these developers, they are building on top of all this ecosystem, right? Meaning that, let's say if there's any enhancements, it can be incorporated into these ecosystems, and it makes it easier for other developers to build on. So I think the ecosystem, the keyword here is ecosystem, right? It's very important, and it is very rich for Nvidia. But for ASICs, because you are designing your own things, of course you can do your software, but you are only doing for yourself. I mean, if you need to weigh the effort, the cost, the R&D that spent on that ASICs, and then how much can you deploy on that, right? So there's no economy of scale for ASICs. Whereas for Nvidia, any R&D that they have done and on the software side or on the hardware side, it will just carry forward to all the other customer as well, right? So I think the scale is very important here. The software side is very important. And somewhat, let's say if there's any new model that came out, right? Say for example, or it could be DeepSeek, or it could be any other models that came out, right? Nvidia chips will be the first, because it's a lot easier to use a general purpose chip to pivot to the new model. Whereas for ASICs, right, maybe they can be useful for those models that kind of like fixated already. Okay, this model people won't change already, but still there's demand to run inference on it. Then of course you can design some ASICs. But remember that ASICs only fitted for one model. The moment people move away from that model, I don't know what happened to the ASICs, right? For customer, they always need to weigh the effort that they put in versus how much value that they can extract. So that's why Nvidia is superior in that sense. All right, the third one, end-to-end capability and ubiquity. We are also really good from the end-to-end, from data processing, the curations of the training data to training of the data, of course, to reinforcement learnings used in the post-training, all the way to inference with test time scaling. So we are general, we are end-to-end, we are everywhere. For many people, right, when they talk about generative AI, they thought that there's only two phases. The first one is training, the second one is inference. Of course, these two are the biggest one, and these two are the most important one. But for those developers in the AI space, they know that it's not just two. Aside from the training of data, right, you still have the post-training, and the post-trainings, it could be reinforced learning, or it could be all sorts of different techniques being used. So I think Nvidia is really good in terms of like from end to end, from the pre-training to the post-training to in between. They are so good at all this, right? It's because they have spent so much time working side by side with the developers to help them. Basically, they ask them, right? Like, I mean, before all these things picked up, right? They ask them, what do you want? And then they work with them. They create the software. They create the platforms. They create all sorts of tools, all sorts of software to help them in this process, so that as long as you are buying Nvidia chips, you're buying whole package, right? From end to end, you can just use their software, use their stuff. And if you are using their stuff, it's a lot faster for you to deploy, and it's a lot faster for you to create your product. Whereas let's say if you are using ASICs, basically you have to move from one software to the other. I mean, it's all over the place. So it's just not streamlined, and it will be using a lot of time just sorting up all these different things, right? And usually their customer, they don't want to spend all this time doing all these things, because that is not their value. Their value is really coming up with good product, good services, and just launch to customers, right? So it's better for you to just buy Nvidia product and speed up your process, because you have to know from startup or from software or from from startup perspective, is that they are all competing with each other, right? Whoever can move faster is always good, right? So I think that's the selling points. And then the fourth one, superior performance and efficiencies. And the third thing I would like to say is that our performance and our rhythm is so incredibly fast. Remember that these data centers are always fixed in size. They are fixed in size, or they are fixed in power. And in our performance per watt is anywhere from 2x to 4x to 8x, which is not unusual. It translates directly to revenues. And so if you have a 100 megawatt data center, if the performance of the throughput in that 100 megawatt or the gigawatt data center is 4x or 8x higher, your revenues for that gigawatt data center is 8x higher. So I think what he's trying to say here is that sometimes you need to know, for those who are building all this server, right, the data center is really limited by power. So that's the limiting factor. And once you have a place for you to host all these servers, and you are only given 100 megawatts, you want to throw in the best chip into those data centers so that you can generate all these tokens, because the tokens, right, is essentially the revenue driver. You don't want to cap just because your data center is 100 megawatt, then you want to save on your chip, you go and throw in some chip that is not as the performance is much lower than Nvidia chip. Then actually what happens is that your revenue will be a lot lower. You don't want that, right? You want the best chip, and then so that you can drive a lot of tokens, and from there you drive a lot of revenues, right? So that's why there's a lot of demand. The demand is because all these Nvidia chips, right, is really, really powerful. I think this is not talked often. People might say that, AMD chip is also good. I think based on what I read is that Nvidia chip is still more powerful and is still more performant as compared to the other competitors. Alright, the next one, complexity and value of the software stack. And then the last thing that I would like to say is the software stack is incredibly hard. Building an ASIC is no different than what we do. We build a new architecture, and the ecosystem that sits on top of our architecture is 10x more complex today than it was 2 years ago. So bringing that whole ecosystem on top of multiple chips is hard. I think what he's trying to say here is that just because ASIC is designed in-house, and ASICs can be efficient if you just measure on a specific workload, right? But actually the software stacks, right, that you want to build all this software to do all these works, right? Software stack for ASIC is not easier than the GPU software stack. So I think what he's trying to say is that there's still a lot of effort, still a lot of money being thrown into this. So it's just not superior. I mean, Nvidia is always the better one. You might ask, like, if it is so bad, right, why all these companies like Meta, Microsoft, Google, they're all designing their ASICs, right? I think they are doing that not because it is better. They're doing that is just as a form of insurance. Because say, for example, let's say, do they want to count on Nvidia for so long ahead, right? If they have their own, they design their own chip, of course they can reduce dependency on Nvidia. And it's always good, right? Say, for example, let's say TSMC, right? They build fabs in US. It's not because building fabs in US is better. It's more like an insurance, right? And that insurance is also asked by US. So I think sometimes companies, they are doing things not because it makes sense from economic sense. Sometimes they are doing that because over long horizon, right, or long term, right, they want to have some backup plan. And sometimes that backup plan can be costly, but still is when it comes to insurance, sometimes you just need to pay that insurance, because if not, right, you will always be counting on someone else, right? So that's why, and they have money, they have the capital to do that, then they can do that. You don't hear like small companies, small startup doing all this ASIC because it just doesn't make sense. Okay. All right. I think the next one, the business decision, deployment and market adoptions. And then finally, I would say this: just because the chip is designed doesn't mean it gets deployed. And you have seen this over and over again. There are a lot of chips that gets built, but when the time comes, a business decision has to be made, and our ability to deploy is lightning fast. I think this one, just look at the track record, right? When it comes to the Blackwell, they design the chip, they just roll it out, right? Of course, there's some problem that they need to tackle when they deploy it, but still they are working really, really hard and really, really fast to sort it out and then just roll out, right? Whereas let's say for all the other ASICs, right? Maybe Amazon one I think is slightly better, but there are many companies that announce that they will design chips, but you need to track, have they really produced those chips? And second question is that how many chips have they produced? Quite often you will see that all this effort, right, is just in a much smaller scale as compared to whatever Nvidia's number is. So that's why I say it's really just an investment for the long term. It's not really something that is able to compete with Nvidia at current point. In future, maybe they can be larger, can be more in terms of the share can be higher, but at current moment, I would say that it's still much behind. All right, I think this one, I won't read it up. It's just a summary of what I just mentioned. And all of this, right, is just, I mean, one answer from Nvidia. You can read the entire transcript. I think worth to go through the entire transcript. I think there's tons of things to learn there. And I always appreciate questions from analysts like this, right? I mean, question like this is really, it gives chance to people like Jensen to explain in more details rather than, because let's say if Jensen doesn't explain in details, right, and then you will hear those analysts, and analysts, just to be fair to them, they are not expert in semicon, right? And quite a number of them will just, coming up with stuff that they think might be true. Say for example, they might be thinking that, oh, ASICs will take over, ASIC is more efficient. They might say that, oh, AMD someday will be able to compete with Nvidia. And the worst thing is that, oh, Huawei 910 chip, some people will make up all this story to tell you that, oh, Nvidia is screwed, because I think whenever we see that a company that is winning, right, I think for most people, they will think that, we want to root for the underdog, because cannot be the underdog keep on losing one, right? We want to root for the small guys. And if there's any small news that say that, oh, the small guys is not dying, they are actually coming up with something new, right? We get excited because there's at least some competitions, right? If I tell you that Nvidia is winning now and keep on winning, I mean, you try to paint that as a movie story, right? It's really, really boring when a big guy keep on beating the small guy. People wanting to root for the small guys. But sometimes you need to look at the data and assess whether those stories, whether it's true or not. At least here, when we talk about ASICs, at least Jensen clarified that no, they are not winning, we are winning. And I think that one just put a stop on this discussion about ASICs, at least for now. If you want to say, oh, can I project this 3 years, 5 years down the road, I think that is a lot harder, because say for example, if you look at in the past, right, when Amazon, they came up with ASICs, their Graviton chip, right, to compete with Intel. Although if you just measure Graviton versus Intel, it is, I mean, I wouldn't say that Graviton is more powerful than Intel chips, right? It is not the case, but at least Graviton, they have a place to stand. They still serve some workload for Amazon, right? So I think in future, there will be a space for all these in-house custom design ASICs. For example, like YouTube or Google, they have their ASICs for many, many years already. I'm not saying that they won't exist down the road. It's just that for the highest demanding workload, AI workload, right, most of them are still counting on Nvidia chips. I think that is just the facts, and that is based on whatever that we are currently observing, right? That's all about today's presentation. Thank you so much for coming. See you all in the next one.